hearts go out to all of those in Southwest Florida. Most of you know that we have an office down in the Naples area, but the entire coastline was, as we all know, was battered, and we have clients and friends that are down there and had some losses, so our hearts go out to them. But speaking of rough weather, we certainly just closed the third quarter, and again, down again. It was not a good month, folks, down about 8%, and the broader market was down about 8%, and that's the biggest monthly loss since June, and Derek, we continue to get beat up.
Right. I mean, for the first time, 3 quarters in a row, we've seen the S&P 500 and the Barclays Ag Bond Index down, which is unprecedented. The worst we've ever seen before was 2 back-to-back quarters of negative returns. And this is as the Fed continues to fight inflation, trying to get an amelioration of demand. And as a result, this week, the S&P was down to another 2%, the NASDAQ 2%, and small caps, curiously, were actually roughly unchanged for the week. So that's perhaps a good sign going into the fourth quarter.
Yeah, that could be a good sign as we head into the fourth quarter, which generally is a better time of the year, but we certainly have been beat up significantly since the Fed said they're going to continue to raise interest rates until they wring inflation out, and which means, of course, another rate raise at the next meeting in November and perhaps another one past that. So, folks, until we see the Fed take their foot off and not raise rates anymore, and the 2-year Treasury seem to settle down, we think we're going to have further pressure.
Right. The 2-year Treasury actually at one point this week almost got to 4.5%, and the 10-year Treasury traded at 3.99%. So again, significant interest rate increases. And one of the things I was told by a friend of mine who works at a hedge fund was that risk parity strategies have had a lot of problems. Says when volatility expands dramatically in the asset classes like fixed income or currencies or the S&P 500, it forces those fellas to reduce exposure. And I think that's one of the reasons why we saw that spike in interest rates earlier this week, which the Bank of England actually had to address by basically buying bonds, not in a quantitative easing mood, but just to provide liquidity to the market.
You know, you did bring something up just a moment ago about the third consecutive negative quarter. You know, of the 187 quarters, you showed me a nice piece, of the 187 quarters since 1976 that showed 3 consecutive periods of down, both in bonds and stocks. This is the first time.
Right, and this is mostly difficult for folks that have a very conservative asset allocation. I mean, in our investment committee, we were concerned that with low interest rates, there really wasn't a lot of defense in terms of owning treasuries when they were yielding under 1%. But at this point, you know, we're back to more normal levels, and for the first time in a long time, you could say that the fixed income market offers some traction relative to equities.
And the question becomes, you know, if we're going to have a recession, which seems highly likely next year, the question is, how deep is it going to be, and does the Fed pivot? In other words, do they stop or do they change directions? And they're probably not going to do that, because that is perhaps the mistake that Volcker made in the 1970s, which was a stop-and-go policy. So until that happens, we're going to have to watch this very closely, which means there are places to be in your investment portfolios that are better than the others, and this is the time to take a look at it.